I had a conversation with a client last week who's a regular viewer of these market updates. They asked a great question. Why did both stocks and bonds sell off so sharply after Wednesday's Federal Reserve meeting? I think the answer has less to do with what the Fed said and more to do with what it didn't say. Under Chairman Kevin Warsh, the Fed has intentionally shifted its communication strategy. Warsh has argued that the Fed has spent too much time providing forward guidance and wants markets to, as he says, play the ball, not the referee. In other words, focus on the economic data rather than trying to interpret every word coming out of the Fed. He's also suggested the Fed doesn't need to communicate as frequently. And actually, one topic that was discussed at last week's meeting was the possibility of reducing the number of FOMC meetings from 8 per year down to 6. That's a perfectly reasonable philosophy, but it does leave investors asking an important question. If inflation doesn't cooperate, what exactly will the Fed do? Torsten Slok, someone I follow, he serves as chief economist at Apollo Global Management. He captured the issue with a great analogy over the weekend. He said, it's like someone saying, I'll take you from New York to Los Angeles, but I'm not going to tell you how quickly we'll get there, what it's going to cost, or how we're getting there. So if I said that, you'd probably start wondering whether you're actually going to make it to Los Angeles. That's essentially where markets are today. Investors still believe the Fed is committed to restoring inflation to its 2% target, so they understand the destination, but what they don't understand is the roadmap. Now, I can honestly argue both sides of whether the Fed should raise rates from here. There are valid arguments on each side, but that's not really the issue. The issue is that markets function better when they understand the Fed's reaction function. What economic conditions would actually cause the Fed to raise rates? What would keep rates unchanged? And what data would convince policymakers that higher market interest rates are doing enough of the work? So in fact, during last week's press conference, Kevin Warsh suggested that higher market rates are actually tightening financial conditions and reducing the need for the Fed to do additional tightening itself. Markets don't need the Fed to promise anything, but they do need a framework for understanding how decisions will eventually be made. Without that framework, investors are forced to fill in the blanks. And that's exactly what happened after last week's meeting. Some investors concluded that rates could remain higher for longer, or even move higher if inflation remains stubborn. And that uncertainty pushed Treasury yields sharply higher. And because Treasury yields affect both bond prices and stock valuations, we saw both asset classes decline together. Today, the 10-year Treasury yield is around 4.7%, while the 30-year Treasury has climbed above 5.2%. It's approaching the highest levels we've seen in nearly 2 decades. Those higher yields matter because they ripple through the entire economy. For households, mortgage rates have climbed to their highest level in about a year. Mortgage purchase applications remain roughly half of where they were during the late 2010s and well below the levels we saw during the post-pandemic housing boom. Businesses are also feeling the effects. One area we're watching closely is artificial intelligence investment. Here, Goldman Sachs actually came out with a report over the weekend, and they estimate that hyperscale technology companies could issue roughly $400 billion of new debt globally next year to finance the artificial intelligence build out. When borrowing costs rise, funding those investments becomes more expensive, which can eventually pressure margins and impact investment decisions. But higher yields have an impact on broader stock market as well, particularly those growth companies whose earnings are expected further out into the future. Those future cash flows become less valuable when interest rates rise, and that can put additional pressure on near-term valuations. That's one reason that we've seen increased volatility in many of the companies tied to the artificial intelligence build-out. It's also one of the reasons we're continuing to emphasize diversification here across our portfolios. So in the end, we don't know exactly where rates are going to go from here. We don't know exactly how the Fed will respond to future inflation data. But we do know that concentrating too heavily in one theme or one part of the market can create unnecessary risk when the outlook becomes less certain. We'll continue to watching both the economic data and, just as importantly, how the Fed communicates its strategy going forward, because the destination, which is price stability, isn't really what's in question. It's the roadmap that's in question. Thanks for watching. I'll see you again next week.